Good morning and welcome to today's Cota Access webinar. We'll be talking about account-to-account payments and why they're taking off in Europe. Interest in real-time payments, and account-to-account payments are a form of real-time payments, is increasing globally. Here in the US, consultant Bain Company has forecast that alternative payment methods like account-to-account could drive peak card as soon as 2029. More recently, Visa and MasterCard announced a landmark settlement with merchants on interchange fees that for the first time will allow merchants to promote certain types of payment methods over others. In Europe, where real-time payments and account-to-account payments have enjoyed more regulatory support, the market is now experiencing acceleration. With us today to talk about account-to-account payments and see what lessons can be drawn from around the world to think about the US market is Todd Clyde, the CEO of Token.io. Welcome, Todd.
Thank you, Kevin. Very nice to be here.
Let me give a little bit of background before we jump in on Todd. Todd, you've been at Token for 7 years and the CEO for 4 years, and you played a key role in transitioning Token from a provider of regulatory compliance APIs to now being the leading enabler of account-to-account payments across the UK and Europe. Todd has 38 years of experience as an executive in software and technology. Prior successes include senior roles at Digital Think, which enjoyed a $2 billion plus IPO, several senior roles at Clairmail, which a mobile banking provider that was acquired by Monetize for $500 million, and other senior roles at Prisma and Mindjet. Good morning and thank you, Todd. Todd, let me start out by posing a first question. Most of our audience are Americans. We might have heard the phrase real-time payments, may or may not know much about them, but I'm going to assume that few in our audience are really familiar with account-to-account or A2A payments. What can you explain to us about A2A payments and what are the benefits that they offer to merchants and to customers?
Sure. Well, first, everybody, wonderful to be with you. I'm based in London, so it's afternoon here. And Kevin, to answer your question, what are account-to-account payments? It's interesting. I don't think there could be a worse term for these types of payments because every payment originates in the bank account of a buyer and ends up in the bank account of a seller. So what we're talking about here is how the money settles or how the money moves. So if you think about it, if you're a seller, you could accept a wallet, and that means we both sign up for the wallet and the funds settle within the wallet. If you're a seller and you accept cards, I could pay by card and the money is settling or moving over the card networks. So what we mean by account-to-account payments are you accept bank transfers and that the funds settle over the national clearing system. So that is settling over automated clearinghouse in the US, and now its successor, the real-time successor called FedNow, or it's settling over faster payments in the UK or SEPA Instant in Europe. So account-to-account payments are as simple as saying pay by bank. And in Europe, what we do see over here now is right on the checkout page, you're seeing pay by bank right next to pay by card. So that's definition of what it is. If I were to walk you through quickly the advantages, so significantly lower cost. Why? Because you're removing the intermediaries of cards and wallets. They settle instantly, which is a huge cash flow benefit to the merchants. They're extremely convenient and low friction for the consumer. So initiating a payment, authenticating a payment is really frictionless. And they're more secure. I know as a payer, I'm not sharing card details with any website or any person. I'm not sharing bank account details with anybody other than my bank. So that's some of the advantages. So how does that translate into benefits for merchants? So it's lower cost, instant settlement, better conversion rates. The benefits for consumers, really convenient, more secure. And really what's propelling them in the UK, Europe, and globally, what's propelling them is this trend towards instant or a trend towards real time. So what's really interesting, Kevin, is 79 countries around the world now have initiatives to upgrade their clearing systems to real time. So you take these real-time national clearing systems, add on easier access, like open banking in the UK and Europe, and this is what's really going to propel account-to-account into the mainstream. So to give you some data, in the UK, 10% of all adults now use this, and it's growing 13% month over month. In Brazil, 75% of all adults now use this, and it's still growing at a decent pace. And in India, 1/5 of the population, or 21%, are using now pay by bank as a primary form of payment.
And Todd, for those in our audience, to give a sense, at least for the merchants, of the advantage, merchants pay in North America over $100 billion a year in payment processing fees. So the savings, which can be significant versus credit, even substantial versus debit, we're talking real money. And for those that might not be familiar, many card networks in the US and Europe settle to merchants on T+3. So the merchant might be waiting 3 days to get those funds and have large working capital requirements that they have to support. So lower fees and less working capital through faster settlement and account to account.
Absolutely. Those are the main advantages that we're seeing over here, and given in UK and Europe, there's a cap on interchange. The US, the cost savings are even going to be significantly greater.
So Todd, Token competes with companies like TrueLayer and Yapily or Kevin AI. As we think about account-to-account payments in the UK and Europe, what are your differentiators versus those competitors, and why do you feel that Token wins head-to-head deals?
Great. Well, yes, I would consider those as competitors, TrueLayer, Yapily, Kevin's recently been in the press for some negative news of not paying their employees. So unlike Kevin, we actually pay our employees. But no, I think there's two unique things that Token does. First, it's our go-to-market, and second, it's our payments network. So our go-to-market, we sell through major payments companies rather than directly to merchants. So we chose that strategy, believing that 80% of merchants don't control their payments pages. They're going to try to buy this from their existing provider, and we're playing for this to become mainstream. We're not trying to win the 20% of the early adopter merchants, which trend towards the higher risk. We also chose that indirect go-to-market really for efficiency. So this is a low-cost payment proposition. So really, efficiency, low-cost, strong unit economics has always been a big focus of ours. To try to bring this to life for your audience, who are our customers then? So our customers are global payments. They're HSBC, ACI, Fiserv, BNP Paribas, Nuvei, Paysafe, Computop. Large multinational payments providers. One key statistic we use is what we call channel lockup, and it's how many payments providers we provide infrastructure for. So an interesting statistic is Token provides account-to-account payments infrastructure for companies that process 44% of all payments volume in Europe. So as the shift happens away from cards to account-to-account payments, we're that invisible infrastructure behind 44% of those that will be processing it. So that's our first differentiator, is really our go-to-market. And we have a differentiated platform for payments providers. And our second is really our payments network. So what do I mean by our payments network? So we connect to APIs provided by banks to enable pay by bank. We uniquely build, operate, and maintain every single connection to every single bank. We chose that as a strategy because we believed that you could differentiate at that connection to the bank. You can drive higher conversion levels, you could drive a better user experience, you could bring more functionality, but also as a network operator, you get significantly higher gross margins. You're not aggregating others, you don't get reseller gross margins. So our connectivity, if you're a multinational payments provider, we can give you coverage in 20 countries across Europe. At least 80%, if not 90% of all bank accounts in each country. And what that equates to is I think we could allow our customers to access 650 million different bank accounts throughout Europe. So I'd say those two, really our network and really our go-to-market, are our two biggest differentiators.
And Todd, if I'm the merchant, and I think about that contrast, if I'm implementing Yapily or TrueLayer, I'm truly having to put a new payment method, into my commerce infrastructure alongside of the payment gateway that I might use to accept cards. Then I've got to integrate that into my reporting infrastructure and my billing and my reconciliation infrastructure. It's a pretty big lift. If the merchant's working with Token and one of your partners, this is showing up in the payment offering that I'm already using from ACI, from Global Payments. It's embedded inside of that. No change to my reporting infrastructure, and perhaps only modest changes to my checkout pages. So vastly easier to implement, vastly easier for me to operationalize. Am I thinking about that the right way?
You absolutely are. So only 1 out of 5 merchants has a payments department. Only 1 out of 5 merchants actually want to control their checkout page and integrate different payments types. 4 out of 5 outsource all that. 4 out of 5 has somebody that purchases payments services, but outsources it all. So again, playing for mainstream, we went after those 4 out of 5, reaching them through their existing provider. And yes, so those 4 out of 5 can, a big way we try to deploy through our customers is to deploy on their hosted payment page on an opt-out basis. And so what that means is, just overnight, they could immediately see pay by bank as a payment option on their checkout page. So they get all the benefits of lower cost, higher conversion, instant settled payments without having to do the heavy lifting of integrating to a new payments provider. And as you said, all the dashboards are the same, all the reporting the same, all the billing the same, settlement is the same, et cetera. So yes, that's why we chose the indirect strategy. That's what we believe the benefit to merchants is.
Todd, let's talk about that indirect strategy a little bit. On one hand, they're large partners. As you point out, they have tens of thousands, if not hundreds of thousands of merchant clients across Europe. If you can make them successful partners, it's phenomenal leverage. How is that strategy going? And what are some of the key lessons that you feel like you and the company have learned over the last couple of years in making that work?
Yeah, so we have a lot of battle scars. I do believe the indirect strategy gives you the most efficient go-to-market, the best unit economics, the biggest reach. But we did find that it took us a long time to get them live. These guys have really full roadmaps. It's hard to get on their roadmap to get integrated into all those things I just mentioned, their reporting, their settlement, et cetera. The other thing is really teaching them how to sell it and eliminating conflicts like on their sales compensation that might be a barrier to the sale. So really, we've done 2 things. First is we've realized that we have to give them an absolute turnkey solution end to end that they can go live with in weeks, and then integrate it into their platform in different ways over time. So that's kind of a secret sauce to getting them live quickly. Then getting them to sell this successfully, we really had to have a mindset shift that these are not our customers, these are our sales channel. So we really just have implemented much more traditional channel management functionality as far as helping them plan, target, train, and enable their sales force to take this to market.
Todd, that maps to my experience as a board member. I felt like 2022 was a year of learning how we could better technically enable those partners. Adding things to your platform like virtual accounts, and then 2023, a year of great learning and progress and thinking about how we worked with them. What are the results that's driving for you today? What are some of the metrics that you can share or signs that these partners are now really driving adoption?
So we've had about 50% transaction growth just in the last 4 months, but maybe a few case studies. So Global Payments, as a customer of ours, has deployed a solution for Virgin Money. They're public with this, that we've seen 1,000 times increase in volume in 3 months, processing hundreds of millions worth of value per month. HSBC, a customer is deployed through a very large card company here, and for an online used car sales. They've seen a 10x increase in volume in the last 3 months. They're processing, again, a couple $100 million of value per month. And the real interesting case study there is a number of these customers I just mentioned, we're seeing they're actually turning off debit cards. And the reason they're turning off the use of debit cards is not because of the cost savings alone, but because they're seeing these bank transfers are actually converting significantly higher than the use of debit cards. So yeah, we're seeing some real good uptake in some targeted use cases, and our customers are now enjoying sales success themselves. And then, that really creates the flywheel. Then the sales reps on their side get interested. It drives more adoption. They start telling case studies internally. So yeah, we're definitely seeing those large initial wins and the significant pipeline that's building behind them.
Thanks for sharing that, Todd. So, in terms of use cases, you talked a little bit about loading a staged wallet, Virgin Money, paying down either a credit card bill or perhaps a loan balance. So a sweep, a payment from one of my accounts to one of my other accounts. There's some changes that are anticipated in the market, at least in the UK later this year, that when we've talked previously, there's optimism that this will dramatically open up the market and expand account-to-account payments to some new use cases. Can you tell us what's changing, and tell us how you think this will bring new use cases, into the mainstream for account-to-account?
Yeah, so just to clarify for the audience, the types of payments I can do right now, right there at the point of sale in the store or at e-commerce, is really single immediate payments. So that's user initiated, user authenticated in real time. So these are user present use cases. So probably addresses 20, 30% of the types of payments we make. What's coming in the UK is defining the rules around recurring payments or variable recurring payments. So think of a direct debit that's easier to set up, that doesn't carry as much liability for the merchant, and as a credit transfer, so it's irrevocable, unlike a direct debit. Why is that important? Well, recurring payments make up another 50 to 70% of the types of payments we make. So it's dramatically increasing the addressable market for these types of payments. So what's that going to look like? So think about, instead of putting your credit card on file or debit card on file, you're going to put your bank credential on file. And your utility providers are just going to, do a credit transfer, not a direct debit. You're going to step out of an Uber, and it's going to charge your bank account. And the other beauty of these types of recurring payments is it also gives the consumers a lot more control. So think about a recurring payment that you could put rules around, where I could say, yeah, I do want to give Uber a long-lived consent to charge my bank account, but I never want to charge more than $50. I never want more than $200 in a single month. I never want it to be after midnight. I'm giving
without
different examples.
a reauthentication or approval of that exception, so to speak. Yeah,
exactly. So single immediate payments have started the market, really catalyzed it. Recurring payments are going to dramatically increase the size of the market and give consumers more control. And then, obviously we'll talk about some of the changes in the US around card rules. And, I think this is really just going to open up the opportunity to drive this major shift away from cards to the use of bank transfers.
So, maybe to recap slightly, today, where you have customers authenticating and approving, or consumers, for each payment, very shortly, hopefully by the end of the year, they'll be authenticating once and putting their account credentials on file. And if I think about advantages, relative to cards, which in Europe, many Americans may not be aware, but in Europe, there's a requirement called strong customer authentication. So every 5 transactions or every 100 pounds or euros, I'd have to re-authenticate. Merchants might actually like the fact that the account credentials on file, A2A, will be exempt from SCA.
Yes. So let's go back to what's available. What's available right now. So right now, I initiate a payment and I authenticate it through a bank transfer. But it's exactly the same as logging into mobile banking, which most people now do at least once a week, if not once a day. So the user experience is really good. Compare that against cards. So as you said, yes, especially over here in the UK and Europe, when you buy something online, you're getting challenged on your phone. So the user experience has become much more full of friction. So even compared to cards, the single payments are equivalent.
Yeah.
VRP, exactly as you said, is going to bypass that strong customer authentication. It's going to really give me a one-click checkout experience. So, I will be able to just say buy now, and it will charge my bank. So it will bring Amazon's one-click checkout experience to every other e-commerce merchant out there.
To pay by bank. And similarly, as variable recurring payments or VRPs phase in, you'll be competing more and more with direct debit, which you mentioned, which can be very clumsy to set up and even more difficult to turn off. So excited by the potential for more volume. Todd, any updates on how quickly the market is progressing towards VRPs or how it's evolving in the UK?
So it's really fascinating because what do the cards bring to payments? Cards bring a rule book. Over here, I was not familiar with this term as an American, but they call these schemes. In American English, that has a little negative connotation. Over here, schemes just mean rules that are being defined. So these bank transfers were mandated by a regulation. Now, as we go into recurring payments, we have to define the rules around them. So, I'd say there's a big focus right now working with the regulators, working with some of the industry bodies to understand liability, understand the commercials so that all the parties can participate, understand consumer protection. So it's really early days in kind of defining the rules around a new payment mechanism. And that's what we're doing. We're defining and we're bringing a new payment mechanism to market. And so we're kind of paced again by how fast the regulators can go and how fast the industry and the banks and the third parties like Token can go and can agree on some of these rules to help govern this new form of payment.
And starting with low risk use cases and expanding outward from there.
Yeah. So again, don't know how much detail to go into for the U.S. audience, but they've decided the harder nut to crack was going to be consumer protection. So they decided to split and launch these recurring payments on low risk use cases, utilities, financial services transfers, and charity gift. And they've deferred e-commerce because that's where you got to get into the consumer protection aspect. So we hope to have, as an industry, have the rules defined for the lower risk use cases by the end of Q3. Token's got some merchants lined up. We have some customers lined up to be live in market with pilots. And then after that will come the higher or e-commerce, which is considered a higher risk that needs more consumer protection defined before they can fully roll that out in mass.
All right, let's shift and address at least maybe the second title that we advertised for the webinar. Is A2A and is RTP really a threat to cards? How soon should everyone expect to see peak card? And maybe that answer is a little bit different in Europe versus the United States.
Well, that was the thesis of Token, when we really pivoted and focused on this 4 years ago. And it was that there would be a shift away from cards to account-to-account payments, and account-to-account payments would become a mainstream form of payment. So why did we develop that as a thesis? Well, the first reason is that cards and wallets are expensive. So a few statistics: merchants paid $161 billion in processing fees in the US in 2022. And card fees were up 17%, even though card purchases were only up 12%. So, cards and wallets are really expensive. The second major driver is national clearing systems are becoming instant. And as I mentioned, 79 countries either have or are upgrading to real time. So our thesis was payments work really well right now, but they're expensive, built by intermediaries, PayPal and the cards. If I've now got instant national infrastructure combined with easier access to that national infrastructure, I could build a lower cost network over which to process payments. So those two drivers are just indisputable to me. And so given that, yes, Bain, as you said in your opening comments, Bain has predicted peak card will come in by 2029. A more interesting fact is they said 90% of all retail payments revenue is at risk of being replatformed away from cards to wallets and account to account. So that to me, I often equate this to the shift from wired phones to wireless networks. Look what happened in that industry and how the players changed. So we're doing that tectonic a shift of the underlying network through which we would process payments, and you're going to see a similar change in the major players. And one last point on this one. So Kevin, you mentioned the lawsuit that was just settled by Visa and MasterCard. Everybody focuses on, hey, they reduced the price, but that was a rounding error. They reduced it by 4 basis points. They agreed to cap it for 5 years. The big change there is exactly what you said, that merchants can now influence the payment type that is used by the payer, either through surcharges, through incentives, et cetera. So I think that's going to be a huge catalyst to drive this shift. So yes, I believe peak card is going to arrive. I think it could be sooner than 2029. There's going to always be a need for a credit vehicle. So I think credit cards are a great form factor for that. But I think the debit card will vanish, within 5 to 10 years, because there's simply a better, cheaper way to move money directly from your bank account. So yes, I agree with the title and the premise of this webinar that peak card is 5 years away.
And Todd, let's dive in a little bit more deeply on that. I have recently read some interesting analyst and pundit blogs and posts in response to the recent settlement that on some level forecast that merchants in the United States might follow the lead of merchants in Europe, where there is differential pricing at many merchants. One price if you pay by card, one price if you pay by debit, another price if you pay by cash. On the other hand, I think it can be potentially a more complex implementation here in the United States to do that. We don't just have debit, we have 2 types of debit, Durbin exempt and Durbin non-exempt. Today, if you think about your partners, our point of sale systems set up to do that differential pricing, or how might a clerk at a retail location understand, thank you, Mr. Clyde, do I recognize the name of your bank, and is this a Durbin exempt or non-exempt debit card? Will there be some friction? Is Europe likely to be ahead of the United States given its simpler market structure?
How you implement this at point of sale, yes, is going to be tricky, and we've not seen that over here yet. But so we haven't seen it implemented over here. So again, for your audience, there has never been a restriction in UK and Europe from the merchant influencing the payment method used by the payer. So they're more than able to do that. So what have we seen used? I haven't seen the dynamic pricing. I have seen surcharging as a very common, or if you use your card, we're going to charge you an extra % or an extra couple of pounds. The other one is incentives. So one of our customers is the national utility of Portugal, and they would offer you 10 euros credit on your utility bill the first 3 payments you use pay by bank by. Let's give an example in the US. So many in your audience, I'm sure, with Verizon or AT&T Mobile or T-Mobile. All 3 of those used to give you a discount on your bill if you had card on file. They now all eliminated that, and you had to replace your card on file with a bank account on file.
And pay by
And
ACH,
so
that's right.
exactly. So that's how we're seeing will it become more complex and evolve to dynamic pricing? Potentially and probably. But right now we see it through surcharging and incentives.
And, you know, another point of view put forward by many that I agree with, the benefits of the U.S. settlement, you know, probably most likely to be enjoyed by large merchants that understand who's paying them, how they're being paid. Some of the larger merchants, the telecom carriers that you mentioned, they actually will look at the card bins to understand the type of payments in the mix. But quite likely, very little of the benefit accruing to smaller merchants. Provide an example, you know, earlier this week, I stopped by my dry cleaner to pick up some shirts and pay a bill. It's an effort for me to educate that small merchant that they're actually better off having me tap a terminal to get a lower interchange rate, you know, than pay with a card on file.
Yeah, so I read the impacts of the 4 basis point savings to some of the large e-commerce providers out there, you know, like Amazon, and the savings are material. I think I saw 4 basis points could result in $461 million of savings. But you're right, to the local merchant who's doing 10 to 100 million of turnover, that 4 basis points will be a rounding error. So I don't think it's going to be about dynamic pricing on cards. I think this is yet another driver because the cost savings we're talking about on a bank transfer versus a card is an order of magnitude different than that 4 basis points. So, you know, so yes, you could drive a significantly lower cost. So think about all your hairstylists. Think about every place you go and work. It says, you know, your cards are gladly accepted, but cash is preferred. Or
That's right.
so
Well, this will open the door for your partners to launch pay by bank or account to account in the U.S. and have merchants supported by some form of discount or surcharging.
Exactly.
Exciting. Todd, what are some of the global trends that you and your team follow, you know, that give you strong optimism? And as we look at analog markets around the world, Europe, Brazil, India, you know, what lessons do you think we might be able to derive to better forecast what is likely to happen here in the U.S. market?
So everybody thinks the real-time rail is enough. And now, if you remember some of my opening comments, it's instant plus access is what's really propels this. So national clearing systems are designed to move money between banks. They're really not designed to sit in the flow of commerce. So you need to address the access to that. So the key to success in India, so the new real-time rail in India is called IMPS. What launched that to be 70 or 21% of all users was something called UPI, which was universal access to that. Brazil, they have a real-time rail. It wasn't the real-time rail moving money between banks that launched this. It was the easier access through an access mechanism called PIX, PIX. In Europe, it's not the fact that faster payments or SEPA Instant exists, it's that they allowed external access through something called open banking. So, you know, I hear the clearinghouse talking about real-time payments. I hear the Fed talking about FedNow, but all the open banking conversations being led by the CSFB and others are still focused on data-only use cases. None of them are really focused on how do we embed real-time payments into the point of sale? How do we bring real-time payments into the flow of commerce? So I would say the US is, that's the biggest lesson learned is great, you've got the instant payment capability, you got to address that ease of access. And you do hear the FedNow papers refer to it a little bit, but there's really no action as far as externalizing that to third parties such as Token or other payments providers that can really embed this into the checkout and into the point of sale.
So limited use cases in the United States today, but more on the horizon. Look, I think another key difference that we at Cota noticed as we looked across those markets, where India and Brazil have had phenomenal uptake and growth in their real-time, payments networks. It happened in a market where credit and debit usage and penetration was quite low. And at the same time, debit pricing relatively high. In both India and Brazil, debit interchange to merchants looked a lot more like Durbin exempt debit, almost 100 basis points here. Not quite that high in India and Brazil, but much higher than Durbin debit. So a very different kind of landscape here in the United States. One thing I think that will be interesting to watch will be to see, do merchants surcharge for, the very high value, high reward credit cards that many folks, including myself, have been trained to carry. Don't know if you have thoughts about that, Todd.
Yes. So let me go back to the use cases for single payments here, which is the catalyst for these pay by banks. So we see a lot of topping up of wallets. We see a lot of paying off credit cards or recurring payments. We do see a lot of high transaction value. So e-commerce, high transaction value e-commerce is a major use case because the cost savings are so compelling. Tokens average transaction value is 470 euros across all of our customers. And so we're selling used cars, we're selling Rolexes, we're selling Chelsea Football Club memberships. And it's being used in store for these types of luxury goods. So imagine if you've just spent all this time, buying a Rolex.
It's that same high value consumer that the premium card issuers are targeting.
The equivalent of like IKEA in France, it's called Castorama and Brico Dépôt, two home furnishing stores. You've spent 2 hours configuring a kitchen or buying a sofa. So right there at the checkout, they send you a link to do a pay by bank, rather than pull out your card. And so the high transaction value where the cost savings are just so compelling, are the big catalysts for the use in e-commerce and in store.
Well, it will, many regulations, and this might be one that have unintended consequences. Here in the United States, we have a number of airlines that are really card programs that happen to operate aircraft as a side business. Might mean changes ahead for the U.S. airline industry. Todd, my last question, and I will encourage the audience, if people do have questions for Todd or myself, please post them. I think the chat function is enabled, and we'll address those questions. But Todd, how will we know when Peak Card is here and A2A has really arrived, or Pay by Bank? What's your vision, and when will you know essentially that you're there?
Good. Well, as I said, really the thesis of Token was to drive a shift away from cards to the use of account-to-account payments. I believe that shift is inevitable because you've got expensive proprietary networks built by intermediaries, and now we're going to have a new lower cost instant network that's built by assembling national infrastructure built by countries. So I believe it's inevitable. How will we know when we will have arrived? And I kind of always look at 3 items. So one, 10 years from now, a debit card will not exist. 2, these are referred to right now as alternative payment methods, meaning non-mainstream, non-core. So we will know when we've arrived when these are no longer called alternative payment methods and they're just referred to as a digital payment method. But as I've said at some conference presentations I give, I'm not going to leave this industry until I could step out of an Uber and my bank account gets charged, or I could walk out of an Amazon Fresh store and my bank account gets charged. So that's how we will know when we have arrived, when I could step out of an Uber and my bank credentials facilitate the payment.
Bank account on file will be easier than card on file. All right, thank you. Do we have any questions? Well, Todd, with that, let me thank you for making time on a busy day in your afternoon to talk with us. I've enjoyed the discussion. I am excited as a board member and an investor to watch your growth. And, it's just been fantastic to see the company, seeing 8 to 10% month-on-month transaction growth now on a very consistent basis. Well, thank you everyone for joining us. We've certainly appreciate your time and hope you enjoyed today's discussion. Thank you.
Thank you, Kevin.